Thank you all for joining us today. We appreciate your interest in our thoughts. Uh, so the very first thing you should know about Robotti and Company uh, is that we have a proven process we've done for decades, and that is we're bottom-up stock pickers, and the focus in the universe we look at tends to be small cap and micro cap companies, and they tend to be U.S. focused, although we will look anywhere because the world is flat. Uh, the firm is not just me. There's 14 people here who share my passion for finding stocks that are mispriced in the public markets. And in fact, since we've been doing this for a decade, we think that the process itself in our research and stock selection is demonstrable in terms of the results we've been able to produce. And we think that the process is obviously also repeatable. So we tend to look at companies that have a long gestation period for our investments, and we get to know the management and the people and including the other shareholders and the board members and develop relationships with them. And we find that's easy enough to do because the companies we regularly spend time in research are things that are not popular and not grabbing a lot of investor attention. So we don't have to fight for time of the management to be able to talk to us. They're kind of like the Maytag repairmen. No one's calling on them. So they're happy to develop a relationship with us. On several occasions in talking to managements, getting to know the companies and repeated contact and involvement, and including many times we visited the companies, plants, tours, management, all those things. We've actually joined the boards of a number of the companies that we've been invested in. And we find that there's a two-pronged benefit. And actually, when those situations do happen and we do join the board, one of those, of course, is that we have literally a seat at the table in terms of the selection of the CEO, and then working with management and the CEO and the rest of the board in terms of developing business strategy and capital allocation with the intent of helping them focus on how to increase shareholder per share value. So we also, in addition to that benefit for the company, what we also do is we derive the benefit of understanding the business with more granularity and how it works and the industry around it, and then also suppliers, and therefore a larger adjacency of universe, including not only understanding the business better, but of course identifying other investment opportunities. And so repeatedly that's happened. For example, our original investment in Builders First Source led us to identify and invest heavily and become substantially involved with BMC. So there's a repeated understanding of spending time being on the board gives us information and access to a greater universe. So where's the opportunity today? So we definitely think that small cap, micro cap is of interest, and therefore the Russell 2000, which is where those companies populate that index, we think is well positioned, and it's well positioned today based on valuations. And valuation matters, and that's the key element, of course, of our investment approach. And what we'd highlight today is more than ever, valuation matters, and that's something that we think is not necessarily widely appreciated, and so that's important. One of the problems with the Russell 2000 is, as I regularly listen to news commentators and thought people, they talk about the index itself is kind of fundamentally structurally flawed because it has so many companies in it that don't make money. So they identify these zombie companies, therefore make it an index that's really not a very good indicator of a real group. In the meantime, that's what we think the opportunities really are. It's in the zombie 1000. So it's the things that have been thrown away, have been disregarded, have been given up. And therefore, that's where the opportunity is for bottom-up stock research to identify certain companies that have certain attributes that we're looking for that we've honed and developed over decades, and identifying those companies, getting to understand them and identify what the market is missing, and also to appreciate the difference between the assets, what those assets' earnings potential are, and what they're available to be purchased at in the market. And as I say, the valuations today are particularly discounted. So therefore, we don't think you need any kind of external event to really to have good returns over a 3 to 5 year time horizon. The cash flows of the business, the dividends, that process and those economics will in and of itself provide good returns. So when we talk about the Zombie 1000, what we're really looking for are companies. This is a Schumpeter cycle, right? What we do is we definitely invest in cyclical businesses. That's historically what we've done, because that's what we do think is that when those businesses are going through difficult times, you can buy those businesses for much less than what it would cost to build those businesses, because no one would build that business, because either there are very low earnings, no earnings, and in certain cases, even losing money. So therefore, those economic attributes are things that investors don't go after. And so therefore, it provides that opportunity to identify companies that really do have something that is a product, the business itself is correcting. And that's what we really think in the difficult times. What we've seen time and time again is there's a cathartic process. And that is that the companies themselves look at what they're doing, pare back what they're doing. The industry itself goes through a period of consolidation. There are certain participants that exit the business, so therefore the universe gets smaller. So therefore, someone who can be opportunistic, especially in those difficult times, potentially acquiring other assets and augmenting the business and increasing its earnings potential at opportune time, is something that we've been able to identify those situations repeatedly, and that's where we think the opportunity is. And those companies would be classified by someone looking at the market as a zombie company. So that's what we're looking for, right? It's those ugly ducklings. It's things, businesses that are the companies, industries that are beaten up and out of favor. And as I say, earnings are either minimal or even non-existent. And so as a result of that, it's hard to appreciate what the asset value, the business value is, because it's not making money and there's no identifiable quick turn in that business. And so, those situations we think enable us to spend time to do the research, to understand the companies and understand what the earnings potential of the business is and why the current situation is really setting up a longer term opportunity. And as we say, longer term opportunity, what we're looking for is also that business is something about the product offering, the management, the capital allocators who are involved with it, who continue to position the company and augment its opportunities on a go forward basis. When the turn does occur in those industries, those companies, the cathartic process is one in which we do think that there's a very long runway of growth and opportunity. And so therefore, not only have we established the position, but it's not something that we bought at 50 cents and it's worth $1 and then shortly thereafter it goes to $1. Instead, we think we're buying businesses for far less than that. But we also think that those dollars can compound over time when capital is allocated properly. So therefore, the potential and over a longer term is for much higher returns on invested capital. So what we also think is a critical element of executing that strategy of identifying these companies that people don't want to own, and part of that process is frequently they also disappoint and go down in value. And so therefore you can buy the businesses for even less. And so you have to be, we say slow capital is a critical element. And therefore the ability to hold that company, potentially to have a mark-to-market loss, and therefore, but still the company is continuing to evolve through this difficult time and improve its earnings potential of the business. So a comment that people have made to us in the past is they said, well, wait a second, you say you're a small cap, micro cap investor, but when I look at your allocation of what you own, what's the market cap, I see there's a good portion of it is mid cap, and actually some of it is even large cap. And so that again, that highlights the slow capital. And that is once we've established these positions and understand the businesses and understand the dynamics and how that business is evolving and how the potential industry has fundamentally even changed, and definitely the competitive landscape is very different, we can appreciate the fact that there is this long dated recovery and therefore continue to own these stocks. And what we find is, in our mid cap stocks, in our large cap stocks, 90% of those positions were established when these were small cap and a lot of them micro cap companies. So we established the positions. Our slow capital enables to spend the time to identify them and then to stay with them when the recovery happens and continue to benefit. And obviously, one of the things I talked about was, the cathartic process includes consolidation. And so we've frequently had situations where we've owned the number 3 and the number 4 company and they've merged to become the number 1 company, or that is actually a repeatable pattern that we've seen in the past. And as a result of that, when that merger does happen, the market cap obviously is larger because not only is the scale of the two businesses combined, but of course the combination of the two businesses, all kinds of economic benefits, especially in a recovering market. And so therefore the economics return. And in addition, I would point out that many of the micro cap, small cap companies we invest in at the time we invest in them previously were mid cap companies. And so the difficult times, of course, have compressed market valuations of those businesses. But the nature of the business itself is inherently something that probably at mid cycle is a mid cap business. So in a way, we're finding things that are transitorily depressed and therefore small cap and micro cap. But the nature of the business fundamentally and historically has been something that's a larger cap company. So important as to where capital is today, how it's allocated, and why we think the opportunity set is so great for the universe in which we're investing in, and why these companies are so compelling, is we have to think back, of course, in the historical context of what's happened in recent decades. And without a doubt, one of the largest and most important economic factors has been for the last 40 years, so somewhere in the early 80s, where interest rates had gone in response to inflation. Of course, over that 40-year period of time, interest rates have dramatically declined to the point where a couple of years ago they were zero. And so obviously, the cost of money, interest rates, the risk-free rate of return is a key component in what the value of every cash flow is. And so therefore, reduced interest rates increase the value of all future cash flows. And so obviously, this is a period of time where there's been a huge benefit and tailwind. And of course, we think one of the prime examples of how that's then forced capital into where it is, because what's really performed well in that environment, the poster child for that is private equity. And of course, it's been a huge, phenomenally successful component, and therefore it's clearly a very large asset class today. And of course, we would point out that that success also changes the fundamental nature of that business. But I kind of point out that if you go back to the beginning of that period of time, the initial private equity were really LBOs, and LBOs were publicly traded companies that traded at significant discounts to what those assets were worth. And clever people identified that opportunity, acquired those businesses, levered up the individual company, and then went about the process of freeing the earnings potential of that business, and therefore having significant returns, compounded by the fact that they also levered the equity that they had put into the business. However, I would say that there's a reason to think that private equity today is a different business. Instead of buying businesses at discounted prices and taking advantage of that and putting some leverage on it, today it's its own asset class, and it's an asset accumulation business. And the fees associated with that asset accumulation business are significant. So therefore, the motivations of the principals are different today. So in all of those things, we think are things that put all that capital that's been allocated there and taking it away from public markets, and therefore opportunities to identify publicly traded companies. We think that there's risk in that, right? Because part of that process is the businesses themselves actually buy and sell at reasonably close to fair values. You're not buying things at significant discounts to what assets are worth. So that fair value is the starting point for many investments today that are in private equity. That's a very different than its historical position. And then so we think that's an interesting potential reallocation of a lot of capital. The other component about public markets that we all know well is that more and more capital today is not, stocks aren't bought and sold based on individual fundamental analysis of the company. It's really the flow of capital that really determines the movement of stock prices. And a lot of that is indexation. And of course, that makes sense. Over the last 15 years post the financial crisis, right? The S&P 500 has been a phenomenally successful way to invest, right? Extremely low cost. And of course, you own the stocks that have been the best performing stocks and continue to perform the best, and therefore continue to be a larger component. So driving performance. So it's a formula that historically, the last 15 years has been a phenomenal success, and therefore has attracted capital. And it's also taken it away from other places. And so therefore, the taking away part is what really we're talking about and emphasizing, and that means valuations are compressed in a significant portion of the public markets, and that's where we invest. And I highlight this idea that if I'm going to talk about value outperforming or small caps outperforming, anyone who's going to roll their eyes because of that's been something that's been said for 6, 7, 8, 10 years, and it hasn't happened, or there are signs of it occasionally, but it really hasn't been the case. And of course, the fact that it hasn't happened doesn't mean that the elements aren't in place, that the valuation, which we think is the determinant for what future's performance is going to be, isn't there, and the opportunity isn't strong. It's just that it hasn't culminated, reached the tipping point yet. But that's what happens in economics. It frequently takes longer. And of course, our corollary to this comment that the longer it takes, and also the faster it can happen, is the longer it takes, the bigger the potential outcome and positive return can be when it eventually is realized. So we think that there's an extra benefit to be realized in this delayed gratification process. So one of the things we do from our research is this concept of grassroots macroeconomics, right? So we are bottom-up fundamental stock pickers. However, in looking at the individual company and understanding its industry and understanding a component of the industrial American industry and the world industry, because the American companies industrially do compete with companies in China and any place else in the rest of the world. So you understand the world's economic process and you have insights into these businesses and certain long dated facts that are structural changes to these businesses that set up an identifiable pattern for where these businesses are headed in the direction. And two, the critical things that our research highlights is this first one is energy transition. Many of you know we've been investors in historical fossil fuels for 50 years. And therefore, we think we understand the dynamics of that business. And we also clearly recognize and understand that part of energy is energy transition. So the move to renewables is a process that it has been well established, is well underway, will continue to be underway, and is a component of energy and energy delivery. However, that continued evolution is a call on all kinds of resources, and the capital required to build out that renewable infrastructure is significant and dramatic. And so therefore, that's a continual process. In the meantime, the movement toward renewables also means that we think there's been a substantial underinvestment in many of the traditional fossil fuels that in the meantime are the bridge to be able to continue to move ahead, how to have a society and an economy that functions well. So that's an opportunity. The other one is globalization. It's not something that's going away. The world is flat. We all compete with each other. But there's the evolution of globalization. And so therefore, who's competitively advantaged is constantly changing based on the economic inputs in the process. And so one of the observations that we have, of course, is that industrial North America has a huge competitive advantage today. That wasn't the case when I got out of college 40, 50 years ago. And that is due to the significant excess availability of natural gas in North America. So natural gas, and then as a result of that, electricity that even comes from the burning of natural gas, is something that gives North America, competitive advantage in energy-intensive businesses. So globalization, part of reshoring, or part of Europe setting up businesses and moving and migrating to North America, isn't, the Europeans may say it's the passage of the Inflation Reduction Act, but that's only the icing on the cake. The cake is that natural gas feeds the production of chemicals and fertilizers and many things, and can do that here at a much lower cost, which means the price is set by the higher cost producers. And of course, there's an excess margin of profitability that is recognized by the North American producers. So the continued development, build out of North American industrial businesses is predicated on a competitive advantage, low cost energy that we think is sustainable for at least the next 10 years and probably longer than that, given the availability of natural gas in North America, which includes Canada. So therefore, that significant supply, far in excess of our needs, will continue to be that competitive advantage and move businesses around and provide opportunities for many of the companies that we're invested in. So now I'm going to hand it over to David, who's going to tell you how some of the things I talked about come out in real life and are displayed in one of our investments that I'm sure all of you know well. David?
Thank you, Bob. Hi, my name is David Kessler, and I'm a PM and analyst with Robotti. This year, I'd like to draw on just one particular touched upon. And in fact, it was a theme that he spoke about at this year's annual Flow Capital, or perhaps it should be called patient capital. Now, Bob discussed some of the reasons why, in theory, slow capital is a critical characteristic of successful investing. It's our longtime investment in Builders FirstSource that really provides us with an excellent example of how its practical applications ago. Ben Graham was already identifying the latent opportunities that exist in cyclical businesses, specifically when those companies, or in many cases, the entire industry, was facing headwinds and were therefore discounted by investors who thought that the current state of activity was going to become the new norm. All these years later, that behavioral bias still deters most investors who would rather rely on what they think they know to be true, even when it's often not, instead of investing in a situation where there's really a high degree of predictability about the outcome, but the timing of that outcome remains elusive. But in fact, it's that uncertainty that's really a critical element of the opportunity. And as Bob mentioned, the longer it continues, the greater the eventual upside can become. So let's take a closer look at the stock of Builders FirstSource. Since 2009, the stock has fallen by more than 30% on 10 occasions and by more than 40% on 6 separate occasions. Now, one of the first of those was between March and October of 2014. And while no one really likes downturns, especially those of us who are invested in the stock, it's really those difficult times that can actually be a catalyst for positive change. And in this case, this was the period when the Johnson family of Fidelity fame capitulated and decided to divest their ownership of ProBuild. Now, this was really a critical event for the success of Builders FirstSource, because in mid-2015, Builders FirstSource acquired ProBuild. And basically, the resulting entity combined in a company with over $6.1 billion of annual sales, versus Builders, which had roughly $1.6 billion of revenue in fiscal year 2014. Now, in addition, Builders, which at the time of the acquisition had roughly an valuation of $600 million, was able to take out $120 million of SG&A expense, really creating tremendous value for shareholders and making the company the largest company in the industry. Now, that pullback in valuations that affected Builders and ProBuild also affected the remainder of the industry. And that led to another critical event when BMC, which was the 7th largest competitor, and also, incidentally, a company where Bob was on the board, acquired the 8th largest competitor, ProBuild, resulting in the 6th largest competitor of the industry. And all this happened following a 40% drawdown. Now, let's look a little bit forward to another one of the more significant drawdowns, which occurred in early 2020. And of course, much of this drawdown was likely due to an event, the pandemic, which had little to do with the actual industry, but was still a 60% drawdown nonetheless. Again, this provided further opportunities for industry shifting changes when Builders acquired BMC. BMC was then the 4th largest competitor. And the result was the culmination of a combination of 4 of the top 10 competitors that led Builders FirstSource to secure its spot as the #1 competitor and the largest in the industry. And that acquisition, it wasn't only just for size, although it did create both scale and scope advantages. It also increased the range of products and services they were able to sell, which was critical to reducing the amount of materials that builders needed to build houses, which reduced the amount of labor needed, which reduced the cycle time from when a builder starts building a house to when it's finally sold, all adding tremendous value for the customer base. Now, even more recently, we've seen a 30% drawdown between August and October of 2023, and almost a 40% drawdown between March and July of this year. And what are the reasons for that? Could it be increasing interest rates? Could it be the effect that that's having on lower housing starts? Yet even with all of these ups and downs and all of the bumps in the road, Builders FirstSource stock opened in 2009, the beginning of the year, at $1.51. And it closed this past Friday at $186.47. That's a total return of 12,250%, or annualized over close to 15 years, a 36% return. So I hope some of those examples illustrated the concept of slow capital that Bob spoke about. And keep it in mind, as I think it'll provide a good framework for what Bob is about to speak about next. And with that, I'll hand it over to Bob.
Thanks, David. Appreciate that. So what I talk about is, the next company is Tidewater, and we think it has many of the same attributes. A business that was in a period of time of oversupply, no earnings, restructuring, all of the attributes we talk about industries and companies going through difficult times. So, the company itself, so the industry in 2012, 13, 14 was building a lot of new capacity. That new capacity came online at the same time. The demand slumped dramatically when the price of oil significantly declined in 2015. And so for an extended amount of time, you had the industry going through restructuring, which provides the opportunities, right? 2017, Tidewater filed for bankruptcy, came out with 400 billion in debt and 400 billion in cash. So therefore no net debt. In the meantime, was breaking even. 2018, a public competitor, Gulfmark, did the same thing, went through reorganization, restructured, came out with 200 million in debt, 200 million in cash, no net debt, and close to break even on a cash flow basis. And then 2019, the two companies merged, and the merger took out 65 million of costs, so therefore made it much more economic and still had no net debt. So therefore a very strong balance sheet versus the rest of the industry, which was effectively bankrupt, but the banks were kicking the can down the road and avoiding doing anything. So what that did was that set up the opportunity. But yet at the same time, this company, the assets traded for 20 cents in a dollar, 10 cents in a dollar, because the stock performed poorly and therefore it got cheaper, even as this cathartic corrective process was changing for the industry. So fast forward to a couple of years ago, what's happened after that extended amount of time is there's been substantial amount of the equipment really is no longer competitive. And so the supply has dramatically been reduced. 2, 3, 4 years ago, activity picked up because the industry also had adjusted its cost structure to be able to have these projects be extremely economic. So therefore projects were being sanctioned, activity was increasing, the demand for vessels returned. Therefore you got the effective utilization of the effective fleet got to 90%, rates dramatically improved. The rate improvement means 90% of that flows to the pre-tax cash flow line. So there's a dramatic change in the cash numbers. And what happens in those processes is nobody knows what that asset is worth when it's not making money or it's even losing money. But when it starts to have a demonstrable cash flow process, you can identify where it is and you can have some sense as to where the direction and where the magnitude of where that goes is. So therefore Tidewater appreciated dramatically. And so I think everybody knows that stock got to over $100 earlier in the year. But what's happened more recently is, again, one of these things is it's not a linear process when these cyclical businesses recover. And so therefore there's delays, hesitations, things that happen in the interim, and investors in cyclical businesses, or they bought it because it was starting to do well, it was a good port in the cycle, now suddenly have no conviction because their understanding of the business and where the ultimate direction of the business is non-existent. So therefore the movement of capital in and out is really very reasonably uninformed, especially today with how capital flows, things being in indexes. So Tidewater got added to the S&P small cap index. What that did was that created the need to purchase 6 billion shares of a company with 52 billion shares outstanding because it was in the index. Didn't matter if the business started to fall apart or not. They were going to buy that stock. So therefore you get the movement of capital is predicated on inclusion in indexes, positive performance. The fact that it had gone up, I'm sure it attracted a lot of capital. And so therefore algorithms were, this is a stock to own because it's going up. So therefore there were the purchases of the stock that pushed it probably to that valuation, probably a little prematurely, were part of what sets up the opportunity when suddenly there's a slowdown. People don't know how to understand that and they run for the hills. So here's our understanding, and here's what we think 50 years of investing in this industry gives us insight into what has really happened. And what is really happening is, here's a picture of the offshore development of a field. So this, these projects are 3, 5, 10 billion dollars of capital. When the oil companies commit to the FID, the final investment decision, from the time they do that until the time they have first oil, and first oil means first cash flow, that's a 3-year process. And much of the work is actually done in the last year of that process. So therefore, there's a timeline and an identifiable amount of business that's happening that will happen. And so this picture shows some of the graphics on what to do. So to the right-hand side, there's two rigs that are floating in the water. And then what they're doing is symbolizing drilling the wells. So one of the things you need to do is to drill the wells. So there's 10, 20, 30, 40, maybe more wells in an offshore field. That's both producing wells and there's also injection wells because you're re-injecting fluids or gases back in subsurface. So the drilling part of it, of course, is one of the things that is slowed down. What's happened in that industry is new capacity has been reactivated. And so when there's a slight lull in activity, because the FPSO, which is first oil, which is on the far left-hand side, is when it's going to get delivered, a number of those have been delayed. So therefore, if this is going to be delayed 6 months or a year, well, there's no reason for me to spend the money to drill the well today because I can wait now 6 months. I can wait a year to do that. So it's the sequencing of all of the work associated with that is what's happened. And therefore, there's a lull in that process because some of the identifiable parts have been delayed. And so therefore, there's no reason to spend the money too soon in advance of when you need it. And so that's what we really think is happening. And so therefore, we also think that there's an identifiable path to continued increasing activity. So, and why do we think that? This is a slide that every quarter Subsea 7 puts out. FMC Technique FMC also does same slides, and they show the identifiable projects that they think will be FID'd in the next 2 years. The number of projects on their list and Technique's list continue to increase. The scale and scope and size of these projects continue to increase. That means more drilling. That means more boats and more activity. So therefore, there's an increasing identifiable path to increasing activity. So these projects, we think there's a good portion of these do get awarded in the next year, 2 or 3. So there's a continual ramp up in activity. That continual ramp up will mean continually increased amount of drilling that, whether it's delayed 3 months, 6 months, or a year, will happen, and therefore continues to grow. So the process, we think, is clear and identifiable that there's more activity that is already sanctioned that will continue to happen and more projects that are going to be sanctioned because they're economics. And why do we say they're economic? That's the next important driver here. Here's what happened in the offshore business is in 2014, the beginning of 2014, new projects awarded offshore dramatically declined. And why is that? In 2014, the beginning of the year, oil price was $120 a barrel. So it wasn't weakness in oil prices, which a year later you did have, but it was cost overruns. These projects were costing much more money, and $120 oil were not economic. So that's what put the brakes on this business. Of course, that was exacerbated by the fact that then oil price fell apart. What happened is the industry has done a multitude of things to change the process for developing the offshore fields. And those changes in process have been substantial in terms of reducing the cost. So the projects that are being sanctioned today are discoveries that were made 10, 15 years ago. So these are not new recent discoveries, but projects that had been discovered and you've re-engineered it. And so part of that re-engineering really is because of the difficult times, the cathartic process, economics 101, the response of the industry has been a number of companies that used to do a lot of work in advance and spend time and effort and like pre-design a project have gone away. The people at the major oil companies who therefore it was their baby and they managed the project and they said how it was going to work, they've been discontinued at the oil company. So they've pared back their people internally. And so what they've done is they've outsourced it and said to Subsea 7, to Technip, here, this is what I found. These are the wells I've drilled. This is what I think the resources I want to develop. Tell me how to do that most economically, and therefore we will proceed. So by re-engineering the process, they've dramatically changed the costs associated with developing the fields. Therefore, you have fields today that are economic at $30, $40 a barrel. So the current price of oil is not a hindrance to the sanctioning of these projects. And so the slide on the right-hand side exemplifies that, so that 50% of the projects are economic at $35 to $40 oil. So these projects continue to get sanctioned. So that's what we're thinking is there's identifiable project to be awarded. In addition to having already been awarded, these projects take 2 to 3 years to actually execute. the bulk of the work being done in the last year of the projects. And so therefore, that's when there's a call on the resources. In addition, the boat business, we think, is particularly well positioned because the rig process in the drilling of rigs is relatively constant or closer to the advanced part of it. As you get to the very end of the process is when you actually do the subsea in construction and installation. And then you also need offshore vessels to augment that process. And so therefore, the contractor who's going to hire a PSV doesn't know whether that's going to be in a year, 2 years, or 3 years' time. So therefore, it doesn't contract a PSV. But yet, that's an identifiable call on equipment, and there is no incremental supply. So we think, and then the installation of the FPSO also requires anchor handlers, PSVs. So therefore, there's an identifiable growing demand for OSVs and no incremental supply. So therefore, that means incremental capability in terms of profitability. So the fundamental idea in all these businesses that we're buying assets for a fraction of what it would cost to build those assets and replace the assets, and the assets are serving a function that is economic, that therefore they're needed. And so therefore there's a true north, we think, to valuation, and that is what it would cost to build out those assets, because those assets will be in the need and will be required, and therefore that will determine where rates go. In the meantime, the free cash flow that this company has already generated, Tidewater, and in this past year, and the continued growth where it will be in the next number of years. Here's a chart that shows various scenarios. And of course, I would point out that the scenarios are probably 28, 29,000 day rates. In the most recent quarter, Tidewater did disclose that the market setting rate for contracts, so not spot market, but contracts, were in excess, so 37,000, 35,000 for the larger PSVs. So well in excess of the numbers that are modeled out here. So that's what we think. We think this business continues to generate free cash flow. By the middle of next year, it will be debt-free, having taken on $600 million to buy vessels in June of 23. So therefore, and will continue to generate significant free cash flow. So the cash flow generative capacity of this business is identifiable, and we think significantly disconnected from the value of the stock that it trades at today. So therefore, we think all these things are underway. The market is overreacted for a multitude of reasons, including the flow of funds, and the purchase and sale of securities are not based on fundamental analysis, but did it go up? Did it go down? Is it in an index? And so all of those things are driving the valuation of things, and that are not fundamental. And so therefore, that's why we have a high conviction that, once again, cyclical business in a process of recovery. There's a blip in the process. Investors run for the hills, yet the movement and direction and the flow of travel and cash flows are clear and identifiable, and they're positive. And therefore, there's a great opportunity for an entry price at really low economic prices. So the next thing, another industry that we're going to talk about is lumber, and I'm going to turn it over to Theo to tell us about what we think is how that's an opportune industry today, and how it's what examples we have of it.
Great, thank you, Bob. As Bob said, my name is Theo Vandermeer. I'm a research analyst and portfolio manager at Robotti & Company. And so what I'm going to talk about today is the lumber industry, which is kind of the middle of the Venn diagram of a lot of things that we've discussed today. So it's an unloved industry, a cyclical business, and it also exemplifies our definition of slow capital in the sense that we've followed this industry in some form or another for well over a decade, closer to probably 2 decades. And as a reminder, the largest distributor of lumber in North America is Builders FirstSource, which David just talked about, and I'm sure you've heard us talk about ad nauseum. And so where we are today is with unsustainable lumber prices. And even though they've corrected from where they kind of bottomed out a few months ago, most companies are still struggling to make a profit margin at the current levels. So that's really showing that this is an unsustainable pricing level for the long term. We're also seeing individual companies that are trading well below their replacement value. And we're not saying anyone is going to go out and build new sawmills or new facilities in the current environment, but it's another data point that helps us to calculate just how cheap these companies are. In addition to that, during the COVID-19 period, these companies earned outsized amounts of cash when lumber prices were much, much higher. And they were able to use that cash to fortify their balance sheet and protect themselves for environments like the one we're currently experiencing today. And in a further testament to the management teams of these companies, they're curtailing capacity at the right time, and some are even spending some capital at the bottom of the cycle to take advantage when things revert back. We've also seen some hidden assets in the form of duties that Canadian companies have had to pay, and also a long-term tailwind based on housing starts in North America that need to be higher to meet demand. And lastly, this is an industry that's changed fairly dramatically over the years. And one of the things that we know well is the distribution network. And that's changed from two-step distributors to one-step distributors. And their customers are now operating under much leaner inventory levels, which leads to much more volatile pricing of the lumber. And we've seen that in recent months with the very low prices. But just as importantly, we saw that when prices hockey stick during the 2020 and 2021 period, as sawmills saw that they had real pricing power due to those lean inventory levels of their customers. So most industries that we look at can really be boiled down to a supply-demand question. What's the supply and what's the demand? And the lumber industry is no different. On the supply side of things, we've seen, as I said, significant curtailment of production. Just in 2024 year to date, we've seen the top 4 producers in North America have indefinitely curtailed over 5% of their capacity. We've seen 40% of industry capacity in British Columbia curtailed since 2018. And lastly, the beetle kill, which is an invasive species that decimated huge swaths of timberland in British Columbia and some in the US, is really underappreciated in its long-term effect. And I should note, it's not just the beetle kill. That's just one of the reasons for a decrease in British Columbia supply. There are also forest fires, environmental changes, Native peoples protecting harvestable lumber areas. And the reason that these are all underappreciated and really important is that these assets, and by assets, I mean the physical trees, can't be made to grow any faster. They take decades to mature. And so any supply shock is felt 4 decades after the fact. And so what takes up a news cycle for 6 months and then gets forgotten still matters for the next 10, 20 years in this industry. On the demand side of things, we think that there's a real tailwind from North American home building. We've significantly underbuilt homes for a long period of time since the global financial crisis. And even though that's come up a little bit in the last few years, we still need to increase home building to bring that back into balance. And there will obviously be ebbs and flows as interest rates move up and down, economic sentiment changes, political landscapes change, but the underlying fact will remain that we need more homes to balance that. And in the meantime, we are also seeing that the age of the average house in the US has grown substantially. And repair and remodel is a huge part of the demand for timber at large. And so even if we don't build the homes at the necessary clip to bring the supply-demand imbalance for housing starts, we still need to repair those homes as they are on the market and continuing to age. And lastly, I touched on this kind of hidden balance sheet item for these companies. And as a bit of a crash course on what's happened with softwood lumber duties is that for decades, Canada and US have been in a dispute about timber imports into the US. And the latest salvo in this quasi-trade war was in 2019, when the US imposed further duties on any imports. In all, Canadian producers have paid over $6.5 billion in tariffs. But this is cash that's not just gone, it's essentially held in escrow. And historically, Canadian producers have recouped around 80% of the tariffs that they've paid. And in the case of one of our companies, Interfor, even if they got a partial reimbursement of 30 or 40%, that would still mean hundreds of millions of dollars that's currently not being given much value at all, if any. And so we think that these hidden assets that are on several of these Canadian sawmill companies is really being underappreciated. And so to kind of sum up, what we're doing is we're buying companies that are trading for a third of their replacement costs, 1 or 2 times normalized cash flows, and with some hidden assets on their balance sheet. And that's all wrapped in an industry that everyone's written off. They say it's cyclical. They say it's just a crappy business to be in. And that's really where our sweet spot is. It's looking for these significantly and deeply discounted companies operating in industries that people don't want to even look at. So we think we can find some really great value in there, and we think that we have. And so with that, I'll hand it back over to Bob to close it out. Bob?
Thanks, Theo. So that's what we think. We think the current environment, we think, creates a lot of risk to where capital is allocated. And we think there is reasonable reasons to think the underlying fundamentals are in the process of changing. And one of those underlying fundamentals is inflation and interest rates, because that sets the value of every cash flow. And so therefore, the allocation predicated on a very long period of declining rates and leverage is interesting, because where is capital allocated? Does it get reallocated? And we think that there's plenty of risks in much of how capital is allocated today. We think the underlying economic situation, especially in North America, where many of our companies are focused and participating, is extremely strong given the macroeconomic advantage we talked about in terms of the energy advantage and sustainable lower cost of energy in North America. And the continued migration of businesses from overseas to here is going to be aided and abetted by that process. So you've got this tailwind. So that's what we think is many of these companies trade for modest multiples of free cash flow with strong balance sheets today. So we would argue the valuations on them are Ben Graham kind of cigar butt prices. But at the same time, the fundamentals and the structural changes that are happening and are happening will continue to progress, that are slower to metastasize than we think or than people had hoped for, means that there is constant tailwind of improving fundamentals. And of course, that's what eventually drives the market recognition, and its weighing machine versus popularity voting machine aspects to it is when earnings do manifest. And so therefore, not only are they cheap based on valuations today, but we think there is plenty of reasons to identify for increasing earnings stream in the foreseeable future. So therefore, we're excited about what we own. We think there's a combination of factors that make them extremely positive. Again, this is a process that we've been doing for 40 years. As I say, I think we've kind of honed our abilities to do this. And of course, we think it's repeatable and we'll continue to do it again. So would highlight there is a number of ways that you can be partners with us, right? So we do manage separate accounts. We do manage a number of private funds, and those private funds have different portfolio managers, different investment approaches, different universes in which we invest. In addition, from the work we do in identifying this research, we also identify single investment opportunities for positions that we know well. And we have a number of those today. There's probably 3 or 4 ideas we think are compelling opportunities that are extremely timely. And in addition, as I had mentioned in one of the first slides, the business model we have is modeled after what Tweedy, Brown and Gabelli, the 2 firms that I know well, and modeled our firm after. And therefore, we have a brokerage business as well as an asset management business. And so there's another way for you to have a relationship with us and talk to us and share ideas about where we think the opportunities are today and why we think they're compelling. So with that, I think we'll open it up to questions.
Okay, great. Thanks, Bob. So the first question is regarding Tidewater, and it's a couple questions in one. So I'll try and summarize it. But it seems like there's an assumption of new build costs of around 65 million, which is higher than recent orders at 40 million apiece. Why is there such a gap, and what's your take regarding this new build policy? At what point in terms of fleet age will you be uncomfortable not seeing them start to renew their fleet?
Yeah. So let me ask the second question first, and that is at what age? So one of the aspects of the offshore boat business of PSVs is that in reality, the larger PSVs do approximately the same amount of work that smaller ones do. And so there's not technological advances in the vessels that therefore change their capability. That's not true of the rig companies, right? A new deep water drill ship can do things and drill wells at a speed, and therefore it has an economics to it that is vastly different than many of the semi-submersibles that used to compete in deep water that have gotten scrapped and have gone away. So not part of the universe, because there's a technological change to that business, which therefore changes the asset. Not true really with the boat business. So the obsolescence of the boats is something that's very different. So therefore, I really do think that what'll happen is the industry will need more boats. And the idea of you be scrapping a boat, because when you had the option and there were excess availabilities, you could say, oh, I need a boat that's 15 years or 20 years. You're seeing in the last year to two, a number of vessels that are, we would argue from a Tidewater point of view, not as well maintained, that are older, that continue to work through the difficult time, through the tight times, because there was demand for those vessels. So we don't think that there's the same issue. We think the life of the asset is definitely longer than kind of nominally noted. And even historically, what's been the case, right? Because recently, a lot of the vessels that got taken out of supply in the last 10 years, had they continuously worked, might still be working today. But it's just they hadn't worked in 4 years, 5 years, 6 years. And the idea that you were going to try to refurbish something that's been sitting around for that extended amount of time, you weren't going to spend the money to therefore refurbish that vessel and bring it back into service. So that supply went away. And so the supply is at a point today, there is no incremental new supply, which is not like the rig companies that have, there are 10, 15 rigs that are in yards that are available that haven't been reactivated that can come to market. That's different. So the economics, yes, you can build a vessel in China for less money than the 65 million that is presumed to be a European-built, European standard vessel. And I do believe that today, in terms of vessel capabilities and reputation, that the Chinese vessels are competitive, because you do see that in a company like Secor Marine that has 17 vessels, many of which were built in Chinese yards. And Secor Marine recently entered an order to buy 2 new vessels being built in China. So those are viable competitive assets. And so that number may be too high, and therefore is not the real indicator. But the critical part of the question really is, what does that mean? Do we see some new build wall of activity? Because of course, that's what you're talking about. You're talking about, there are, I forget the number actually, even, is it 1,200 PSVs? And so therefore orders for 2, 3, 4, 5, is not changing the supply dynamics. And that's the critical part, is, that we don't think there's any risk to a radical change or any substantial change really in new building activity. And what you've also seen is, even the projects that have been previously sanctioned are in the process of, the speculative builders are looking at what they're doing with those vessels, and they're talking about changing it. And instead of it being a PSV, to actually put a crane on it, so it can be used as a subsea construction, a subsea vessel where there is demand and there is new building activity. And so therefore, they're even looking to repurpose it out of PSVs, given the current slowdown. It has created uncertainty, and therefore has reduced the desirability of thinking about doing new builds. And that's what we think, is that the new build risk continues to get pushed out, is not really relevant, whether it's at 45 or it's at 65. And of course, the flip side is, there are vessels that are, the conversation is, so Equinor wants new vessels, so they want them to have dual fuel with ammonia. Those vessels will cost $80 to $90 million. So that's part of the uncertainty in terms of new builds too. What engine do you have? What does IMO require you to change, and how that vessel might be? So there's a number of factors that reduce the risk, because that's what happens in any cyclical business, right? The cure to high prices is high prices, because high prices means high profits means new capacity. That's the question. And we don't think there's any way that the economics today are at risk of creating new supply, changing the dynamics, especially since these assets service offshore drilling activity, which the future of is still somewhat uncertain. And therefore, it's not only what rate do you get today, it's what rate do you get over what lifetime of the asset. And so there's uncertainty there. So we don't think the new build risk is anything. I don't think it's anything that is of concern in terms of stopping the cash flows for the next 2, 3, 4, 5 years, which aggregate, we think, a number that is equal to and greater than the current market cap of the company. So we think that it effectively assumes no terminal value after 4 years. We don't think that that's a logical, thoughtful, economic conclusion.
All right, thanks, Bob. So just as a reminder, people can submit questions directly into the Zoom. So please, we'd love to hear from you. And as a follow-up to the question that you just got asked, we have another question about Tidewater, which is just asking, are you suggesting that 2025 will be a tough year for Tidewater?
No. What's the definition of a tough year? We'll generate significant free cash flow. We'll have good utilization. And so therefore, is that a bad year? If you're going to make, are we going to make probably less money than we thought we would have made 6 months ago? Definitely. utilization will probably be a little bit lower. There'll be a little bit more rate pushing that people will be doing. The fact of the matter is, we're going to generate a very significant amount of free cash flow, something that is a very high multiple of free cash flow based on the market cap and enterprise value of the business today. When it gets out to 26 and 27, what I actually believe is demand for vessels will continue to ramp up. PSVs, I mean, always, I'll get it yet. FPSOs need to be installed. Subsea equipment needs to be installed. All this equipment will demand increasing vessel time, and yet there is no supply, because even the 3 or 4 or 5 or 10 that are being built today won't be delivered for 2 to 3 years. So the supply isn't changing, the demand is growing, the rates will continue to back on track and generate more money. And that's what we think is 2-3 years out, the business can generate $1 billion pre-tax. And then the question becomes, and when you aggregate next year's cash flow, the year after's cash flow, and the year after's cash flow, how does that get reallocated is a critical element. And that's why we're happy to be able to have conversations with management and the rest of the board in terms of how do we deploy that capital to therefore increase shareholder per share value. And we think this a clear, obvious thing we can do today is buy back stock at today's prices, which is a fraction of what its cash flow generative ability is, and therefore add more value today. So will it be a tough year? I don't think that's a definition of a tough year. Trading at is it 10 times earnings? And I think the earnings a year or two out are going to be significantly higher than that. No, I don't think that's a tough year.
Thanks, Bob. We have another question that's a little more top level. The question is, how does an eventual economic downturn, it's inevitable, affect any of the themes you've spoken about, such as offshore housing?
So interesting. I do think that first off, let me disagree with your assumption. Okay. And the way I'll disagree with your assumption is, for the last 2 years, we've heard the economy is going to slow down, that we're going to have a problem, and therefore that means everything resets. So first off, when recessions happen, and they always happen, there's a recovery period of time. So is your time frame 1 year? Is your time frame 3 to 5 years? And so 2, of course, the economy that matters when it comes to industrial businesses is China. China's been in recession, a deep recession, for 2 years, because what China has done in response to the deep recession is, right, nominal GDP growth in China is positive. Well, how do you accomplish that when you have a recession? Well, you overproduce what you don't need and you dump it around the world. And so therefore it is rampant, the amount of overproduction in China that isn't needed for the Chinese economy and is therefore being sold and dumped around the world. So steel is an industry in which we have a number of investments. And, that's one that the industry itself is under the yoke of what China is doing, and that is overproducing and exporting. And is the number 100 million tons of steel that they'll overproduce and ship to the rest of the world? 100 million tons. Let me put that in perspective. North America produces 90 million tons. That's more than all of North America's production. Europe produces the same thing. And of course, that's the place that it's really being dumped on. It's Europe. So European economies are being crushed, are being crushed by what China is doing. And so, and part of that, of course, is at their own doing, because Europe is decarbonizing. And of course, decarbonizing means deindustrializing. And so in that process, we also think North American companies are competitively advantaged, because more of those businesses are migrating to North America. So therefore, we're the beneficiary of that. So we think that many of the companies that we have investments in, Westlake, Olin, are things that make products that China is dumping epoxy into the United States, and has been for an extended amount of time. So those earnings are already depressed by the fact that you've got that oversupply. So you have to put that in the context, I think. And I don't think that China's economy is going to be in a recession forever. I don't think that that's the new norm. And I also think that the world has woken up to, it's not just North America that's going to talk about like steel and what's happening. The impact on Europe is more dramatic. But you even have countries like Brazil, who are the government friendly to China, also putting duties and tariffs, because the world has recognized that China knows that they're overproducing and is dumping it around the world. So I don't think that's a sustainable outcome. And yet it has a suppression on the earnings, and therefore we're buying these companies at depressed earnings. And those earnings are not sustainable earnings. in the meantime, the balance sheets of the companies themselves are extremely strong, so they can withstand this period of time while they're being depressed. So we don't, the US economy has less impact on steel, and chemicals and fertilizers and all the things we kind of talk about. So we actually think that that's a moderate to lower risk in terms of the investment thesis we have in these companies.
Thank you. Can you comment on your recent involvement in green first forest products, your thesis and how you view it versus other lumber sector investments?
We think we're buying the potential earnings power of the company for substantially discounted at a time when the business and the industry is going through difficult times. We think that they have a plan to substantially change the footprint of their business and the effective economics of the business. And so we think it's an interesting investment in a counter-cyclical industry and facilitating them being able to do the things that fundamentally and structurally change the competitive nature of that business. And in that process, we have had the ability to suggest someone to the board that will therefore have a seat at the table and also work with the board and the management in terms of how to capture the opportunity in an industry we're attracted to at a difficult time and therefore put capital to work.
Thanks, Bob. Question going back to Tidewater. We have a question about if you could expand a little more about their long-term contracts. And are there contracts that really secure cash flow over the next several years, similar to chartering a container ship, or how do they work?
Yeah. So the contracting strategy that Tidewater's had for the last 2 years is to contract relatively short, right? Because the trend in rates has been higher. And so therefore, we're not looking to commit vessels. We actually do have some vessels that are committed for longer term. Those were vessels that we bought from Solstad, that Solstad committed to longer term contracts when they still owned the vessels. And so therefore, we inherited those contracts. But as a general rule, we are not contract long. So therefore, in theory, of course, that means we're exposed if the rates do come down. But and of course, in the boat business, one of the things you need to remember in the boat business is, you are where you stand in the pecking order. Contracts for boats often have what are called cancellation for convenience. So we sign a contract with a major oil company. What that means is we're committed at that price. They change their mind in a year's time. They say, yeah, I don't really want to be subject to the contract anymore. And given the relative weight of the companies, we're not in a position to do anything other than to say, okay, thank you. So therefore, contracting long-term only commits us and in a rising rate environment to take less than what the asset is worth. And a falling rate environment, we're pretty much relatively exposed anyway. In the meantime, that's what we think is the trend in rates continues to be higher. And therefore, we continue, and you see that in the contracts we have and what we set, and the contracts are 6-month contract, 3-month contracts, shorter term contracts, but the contract rates are substantially above where the average rate in the fleet is. So the rates continue to trend higher. And that's why the 2025 numbers aren't going to advance as much as we had thought, because the rate of increase in the rollover is not going to be as aggressive as what clearly was underway. And we think the fundamentals continue to call for that as you have a limited supply, an increasing demand, and therefore the element of moderation there is rates and cash flows.
Great. Thank you, Bob. We have another question here just asking if you have any regrets from 2024 in the portfolio.
Yeah, the regret that we have broadly today is that the amount of capital we have is fixed and finite, and the opportunity set we think is a multiple of what the cash that we have invested today is. So there's a multitude of companies that we're aware of, we know reasonably well, that have valuations that we think are compelling and then have opportunities for growth in those earnings that are dramatic. And so therefore, we're limited in terms of deploying capital, and especially we're limited based on the fact that in order to get capital, that means I have to sell something. That if I have to sell something, I already have high conviction on the economics and the outlook in that business, and then I also have to then incur a tax liability. I'm clearly not going to incur a tax liability to move money from one great investment to another great investment. So therefore, the biggest the disappointment I have about 2025 is that people still don't see the opportunity based on valuations, because valuation matters. And yet people are rampantly ignoring that fact and not deploying capital, instead of deploying capital things that have worked out well, that potentially even have risk in valuation, right? So, I would submit that private equity is something that, the price at which things are marked, is called into question. That's why there's been relatively few transactions that have happened. There's been few monetizations because the bid-ask spread is significant. And I'm marking it at this price, and that's what I'm looking to sell it for, and the buyers aren't willing to pay that. So therefore, you don't get activity. So you don't get turnover. So that capital, and people continue to commit capital to that based on the fact that historically it had done well, and in an environment where interest rates went from 15% to zero. So therefore, the facts are different, and yet the capital still flows as if the facts are the same. In the meantime, the universe of companies that we look at and we understand and we know well, the valuations are modest and the futures look bright. So, but that's what the way markets work, is that the capital is starved for where the opportunities are, because they haven't done well, and therefore people project into the future. Past performance is not a predictor of future results. Right? So therefore, that is a concept that we all talk about, but it's really not shown much in terms of practice. So it'll be interesting. The redeployment of capital will be a great opportunity, and the manifestation of these things are cheap, and the market will eventually recognize that. But
okay, so we have another question here that's kind of a two-part question. What are your thoughts on the shipping business today? And once you're done talking about that, what are your thoughts about natural gas producers? And maybe even if you want to talk about anything in the oil sands companies as well. It's a little all over the place, so you can choose how you break that up.
My general thoughts are that the shipping companies are probably really interesting today. The balance sheets in large part are strong. There's a lot of free cash flows. There's capital discipline. So they're doing intelligent, thoughtful things. There's an ebb and flow based on what war and what place and what sanctions, therefore, that affects the flow of goods and therefore the demand for vessels. So that ebbs and flows some. But we generally think that over the next number of years, the valuations of these securities and a number of the shipping companies, one of the people was in today talking about, they've fallen off 50%, 60%. So therefore, the repricing of these securities that never were darlings of the market or have been really dramatic, and so therefore probably have overshot where they need to be. And so therefore, I would tend to think there's huge opportunities. But then, as I said, there's a huge number of situations that we're aware of, that we know the dynamics of, and we know the fundamentals really well. So for me to go spend time to look at a new idea that's probably cheap and probably interesting, what's the value add in that? What are we going to do? How am I going to deploy capital into that? I don't really have capital to do that. So I think the shipping stocks are really interesting. The gas producers over the next, extended amount of time, natural gas producers in North America probably will see higher prices. There's the demand will increase, whether that's domestic demand from our own use, whether that's increased industrial activity, which consumes more natural gas in terms of making products or running those businesses, and the increased likelihood that we'll export more LNG to the rest of the world. That natural gas is the bridge fuel for what you need to do, and how you get from where we are to a renewable world in which that provides most of the energy. So natural gas demand around the world continues to increase. Consumption in North America or export will continue to increase. That said, there's a sufficient supply that it's not necessarily connecting with the rest of the world at any time soon. And I don't spend a lot of time on the producers generally, and that is because the commodity price is so important in determining the economics of the business. And my thought from 50 years of investing in fossil fuels is I have no idea where the price of natural gas or oil will be in the next 6 months, a year. And the only thing I can say is if there's agreement on where it's going to go, then more likely than not, that'll be wrong. So I do think that's a risk. Now, that said, I will venture out and say, if you want to own natural gas producer in North America, I don't know why you wouldn't want to own one in Canada, right? So you did mention Canadian oil sands, and I think oil sands are an interesting, long-dated free cash flow asset that again is one in which the rest of the world has divested because concerns about the environment. And so therefore, who owns the oil sands in Canada today? The Canadians, because all of the major international oil companies, Total, Exxon, Shell, BP, have all decided, I don't want to own that asset. And so therefore they've gotten rid of it. And so therefore they've sold those things for far less than what the future cash flows of those businesses are. So the owners of oil sands are probably, the cash flows are dramatically higher than the current market valuation of those. In the meantime, natural gas producers in Canada, we think, have a multitude of ways to win. You have a very depressed price, therefore relatively modest profitability that you have today, but yet they're generating significant free cash flow. And with that, what are they doing? They're buying back stock and paying dividends. So the cash yields on these things is, significant. You've got smart people and you've got a reserve life that's 10, 20, 30, actually not 10, it's 20, 30, 40 years. And of course, that 40-year reserve life, if you actually increase production, end up being a 20-year reserve life with twice the cash flows, twice the production level. And in an environment of increasing demand, Canada, next year will become an exporter of natural gas, not to the United States, which is that's the only outlet market they have. So they sell it to us. The only way to sell it to the United States, who's got plenty of it, is you got to discount the price. Instead, the pipeline that Shell will complete will be able to take LNG to Japan and to South Korea. So therefore they'll be selling to the best markets in the world at the highest prices, as opposed to the worst market in the world at the lowest prices. So that's a dramatic change in what the economic cash flows will be to the Canadian producers for their natural gas. And as a result of that, the likelihood of increasing volumes also. So we think there's so you have modest valuations, strong balance sheets, already returns of free cash flows, likelihood of growth in terms of the volumes and the price. And so therefore is dramatically leveraged in a very low risk way to significantly higher free cash flows over the next 5-10 years.
Thank you, Bob. So we're running a bit long on time. So unfortunately, we won't be able to get to everyone's question, but we will reach out to you after the fact and make sure we get you guys those answers. I'll just finish with one last question here, which is, we have someone who's asking, I would love for the presenters to share their 5 to 10 year outlook, what their big picture perspective is, and to highlight any investable ideas that align with that vision. This could be specific and actionable insight or broader concepts, and just kind of getting an idea of what our long-term view is.
We think actually economic activity in North America is strong, right, from an industrial point of view, because of the competitive advantages that we notified and identified. And as a continued build out of the industrial complex in North America because of that. That's the evolution of globalization. And so instead of us being the net loser in that process, potentially we have things in place that make us a net winner. And so therefore that we think over time markets respond to economics. So we think we've identified a number of different businesses, right, that all have those attributes. Again, they start with modest valuations to begin with, but importantly, these are important structural changes that are identifiable that we think increase the demand for their products and services and increase the profitability and the returns, and changes the perception of these businesses being crappy cyclical businesses to businesses that provide a product or service that's in high demand, that's in limited supply, and do that extremely economically. And so that's a different business that therefore has different multiples and valuations on it of increasing profitabilities and cash flows.
Great. I might just add to that actually that, when we think of these 5 to 10 year outlooks, it kind of goes back to what Bob talked about earlier with the grassroots macroeconomic views. So we don't spend a lot of time thinking about the general 5 to 10 year outlook. We look at the 5 to 10 year outlook of the specific companies that we're looking at, and we're formulating what is the economic environment for those companies. Are they the best positioned, or is it a customer, or is it a competitor, or is it a supplier to them? And so by looking at each of these industries and figuring out the economics for individual companies, we can kind of generate those broader outlooks for those specific industries.
Thank you all so much. So well, we hope you had a pleasant Thanksgiving, and the rest of the year gives you much happiness for you, your families, and a very healthy, happy, and productive and profitable 2025. Thanks so much. We appreciate your continued commitment and involvement and belief in what we're doing and how that works out well for all of us. Thank you.